Alright, guys, we've said it many times. China wants out. They are tired of the established system. And just talking about the US dollar gives them nightmares. I think we've reached a point in China's treasury dump where this is more than just a trend, it's becoming a mission. The latest treasury data is out, and guess what? China just dumped again. Their bond holdings have collapsed. It has fallen another $13 billion from June, and over the past 12 months, the dump has edged higher to $117 billion. China has been dumping for years. And if you're seeing this chart for the first time, it might shock you to realize that back in 2011, Beijing held over $1.3 trillion worth of US debt. And consider the environment that we are in, right? The Fed rate hikes are ending, and we are moving towards a recession. Germany is contracting, and the Eurozone is still in economic pain. And this means there's even more incentive to hold dollars, right? This knee-jerk reaction is to run to dollars as a safe haven trade. Investors and countries, they all buy dollar assets. But China is bucking the trend because it's no longer just about economics, but now geopolitics. And following this dump, the former advisor to China's central bank, the PBOC, came out with a warning. He's suggesting that China should keep selling US debt to support domestic growth, and his reasons are both economic and geopolitical protection. Listen to this. Under normal circumstances, the yuan's internationalization could reduce exchange rate risk and transaction costs for Chinese companies. But if the United States decides to freeze or seize Chinese assets and refuse to pay its debt to China, there's nothing to stop it from doing so. And that is the extreme risk we have been talking about. Treasuries bought by foreign central banks are held within America itself. They are held by custodians in the United States, such as the Federal Reserve or the big commercial banks. If Russian reserves could be confiscated, the same thing might happen to China if an economic war breaks out. And according to the advisor, China should sell US debt and buy resources actually needed to grow its economy. They should rely on domestic demand rather than external demand. And every time China buys US bonds, they are effectively lending money to America to buy Chinese goods, right? They are providing the US with money that they didn't save themselves to spend on stuff made in China, and that is driving external demand for China's economy. And that used to be a win-win proposition, but Beijing realizes two realities. America can't possibly pay back their debt without extreme measures, and there's always the threat of sanctions where your assets can always get frozen. And that's why China is now dumping their US bonds and buying up natural resources instead. In a story from Bloomberg, China signs 27-year Qatar LNG deal to boost energy security. China has effectively committed around $60 billion for a 27-year LNG supply. They are swapping dollars for 4 million tons of LNG yearly. And just think about it, which is more important if you are China? Actual energy that you can use or treasuries held in the United States that have extreme counterparty risks. And the answer should be obvious that even a monkey can figure that out. But let's talk about the third reason why China is deleveraging their debt holdings. Even if they aren't dumping directly, they are allowing the debt to mature without rolling it over to new bonds. And that's because when you buy US debt, you are effectively financing Washington. You are giving the US government money to spend however they want. And in normal times, that's fine, right? But look at the laundry list of actions taken by US on China. And this is very disturbing when it comes to the tax sanctions. And the main aim of the sanctions, all those import and investment curbs, was to limit China's chip making capabilities. They wanted to restrict Beijing to only 14 nanometer chips. But guess what happened? China had a tech breakthrough. Huawei developed its own 7 nanometer chip and integrated it into their new phone. And this means Beijing has access to faster computational power and can harness the full potential of 5G technology. And you would think that the US would drop their sanctions at this point, but no, they are going even full steam ahead, and it might get even worse. Things are getting out of control. Lawmakers in the United States are calling to punish China for their chip breakthrough. They are demanding full sanctions and charges against China's Huawei and their chip maker SMIC. And if this isn't economic warfare, I have no idea what really is. And if this goes through, all the export licenses will be revoked to Huawei and SMIC. They won't be able to import tech from the US anymore. America is afraid of China's tech rise. They didn't believe Beijing could catch up, so they might impose even more restrictions. And if you're China and you're looking at this state of affairs, does it even make sense to finance the US government anymore? Even if US Treasuries are yielding 5 or even 6%, does it really make sense to increase your holdings? Not really, right? You either eat a loss and sell them off now, or you slowly unwind your positions by allowing existing debt to mature. Then you take the cash and you buy things that you really need, like oil and gas. You don't need a genius to figure this out. And by not buying US Treasury bonds, China is removing a bid in the market, and this causes America to borrow money at higher interest rates. And since the start of the Fed rate hikes in 2022, the borrowing costs on US debt have been going up and up. In August, the average interest rate on the US debt has hit 3%. We are now back in the 2009 levels, and this is going much higher the longer the Fed doesn't pivot. By reducing their debt holdings, China is making it more expensive for the United States to fund their policies and measures against Beijing. And another reason why China's done with US bonds is really because of US monetary policy. The problem with the dollar system is that it's essentially a currency prison. When interest rates are low, the world doesn't really feel the effects, right? Money flows from the US towards emerging markets like China to chase yield. That's what happened over the last decade or so. But now that rates are going up, the dollar has become a cudgel, a club, clobbering national currencies around the world. And this creates two dilemmas, guys, both of which are inherently unfair, but they help to defend the dollar system. And you must really understand this. This is why the US dollar isn't easily dethroned. When you hike interest rates, you drive down the value of US bonds. It's a very simple relationship. The higher interest rates rise, the next batch of bonds have a higher yield. And this also means your current bond holdings that you have right now are devalued. They are worth less and less as rates go up and up. And according to Fidelity, this devaluation can be severe. A 1% increase in interest rates could be a 9% devaluation of a 10-year bond. So when the Federal Reserve hikes rates by 1%, the value of 10-year treasuries could crash by 9%. A 3% rate hike could mean a 27% drop in bond values. And you can bet the Federal Reserve, they know this. And by hiking rates, they put bondholders in a trap. Sure, you can sell your treasury holdings away, you can sell it all away, but you'll be eating a loss. Why don't you just hold on to them all the way to maturity and let us borrow even more money at a cheaper rate? It's the devil's deal. Bondholders are free to sell and they can leave the system, but they might have to realize a horrifying loss. And it gets crazier. Remember that the Federal Reserve, they took rates from near 0 to 5.5%. We don't know the true extent of the damage done to the bond holdings of all the central banks. And this is the prisoner's dilemma China and all other bondholders face. This is how the US bond market defends itself. After all, the dollar is the reserve currency and you still need it at the end of the day. And that's why China's bond holdings are going down gradually. It isn't an instant down from $800 billion all the way down to zero, right? They will be eating a big loss, so they might be simply allowing their existing bonds to mature. Looking at the Chinese yuan to the dollar, we can also see a second dilemma. When the Fed hikes, the value of foreign currencies like the yuan normally crashes, as since the start of the rate hikes in 2022, the yuan has fallen by at least 10%. While this could be good for Beijing's exports, it makes their imports more expensive. The majority of commodities and imports, especially from the US, are priced in dollars. China is still in the process of creating all those bilateral trade agreements, right? And until that happens, US monetary policy can be used as a weapon to punish the value of the yuan. And that's why we are seeing Beijing de-dollarizing their trade. They are also taking their dollar holdings to buy things they really need, like oil, gas, and food. But to store value, China is going for gold. In a story by Bloomberg, China's gold binge extends to 10 months as reserves climb. The Chinese have added an additional 29 tons in August, taking their reserves close to 2,200 tons. And let's take a look at this chart from the World Gold Council. This is the PBOC's gold purchases, and we can see a big trend developing. China has been publicly announcing their purchases since December last year. Plus, a greater percentage of their total foreign reserves are now in gold, exceeding 4%. Now, I believe China is planning something big with their gold. I don't have any proof, but it has to be more than just a store of value. We know that gold removes counterparty risk, especially when you hold it in physical form. There has to be a plan for China's purchases when interest rates are at a record high. Maybe they are planning to trade it in gold one day, maybe they might link it to a trading currency, but either way, we have to pay attention to China's gold purchases. However, it isn't just the Chinese government buying. Local people are stacking gold like no tomorrow. The premiums on physical gold in China have just reached a record high of 6.4%. There's just too much demand and not enough supply in China. It's essentially the same situation as people in Japan. Everyone's rushing for gold to protect their buying power. If you're Chinese, your options are limited. Real estate is still in a crisis, so home prices are going to keep sliding down until things normalize. Then the Chinese stock market is also unstable thanks to the trade war and economic restrictions from America. So where do you turn to? The last resort is buying physical gold. There's not much choice here, and this chart explains everything. If we track different asset classes in 2023, gold has outperformed every other investment except for the S&P 500. For the first 8 months of this year, gold has appreciated in value by 13% in Chinese yuan terms. It has beaten cash and even US treasuries. Most people in China don't really buy international equities. In 2020, over 95% of Chinese ETF holdings are domestic equities. The only avenue left would be gold, and that's why the price of gold hasn't collapsed even though interest rates are at a record high. The dollar is crushing local currencies around the world like the Chinese yuan and the Japanese yen. So people around there are all running towards gold. It's not just China's central bank, but people on the street. Chinese money is not flowing to treasuries, but into gold instead. But let's touch on the economic reasons why China is cutting down on their bond holdings. The problem is the end game of the US national debt, and this current path is simply unsustainable. The US national debt has broken past $33 trillion. Do you know how crazy, how insane this really is? They keep borrowing and spending money like there's no tomorrow. There's only so long you can kick the can down the road. Sure, a lot of that money was borrowed during the Trump era when the lockdowns hit, right? A crazy 50% increase in federal spending between 2019 and 2021 happened, and that added a ton to the national debt. But Joe Biden is doing nothing to reduce the debt. In fact, he is spending even more. You throw in the Inflation Reduction Act, the irony of that, right? Inflation Reduction Act, and the aid to Ukraine to the debt, and everything just balloons up. The deficit in 2023 alone is expected to hit $1.5 trillion or even more. We are fast approaching a point in time where the fiscal cliff is getting closer and closer. And the fiscal cliff is simple to understand. It is a point in time when borrowing money simply becomes impossible. And there are many metrics to measure things. I know some people love to use debt to GDP, other people compare the interest payments to GDP, but I like to get even more specific. This is a chart of the US government interest payments as a percentage of tax receipts. In Q2 2023, the number is now 36%, and this means more than a third of tax revenue goes to pay off just the interest on the national debt. For every $100 the government brings in, $36 gets paid out to settle the interest payments, and that's even worse than using a credit card. At least the rate is capped at 20% max. So what happens when we hit 40% or when we hit even 50%? What happens then? Well, the Federal Reserve will have to make a terrible decision. Do we save the US bond market or do we save the US dollar? Because either way, one of them will have to be destroyed. If the Federal Reserve keeps interest rates high, the dollar's buying power might be safe, but the entire bond market will implode, and America could default on their debt by simply not paying. But if the Federal Reserve decides to save the bond market, you have to print money to inflate the debt away, and that in turn destroys the buying power of the US dollar. And it's likely going to be the second option, right? And that's why countries like China have the ultimate motivation, the ultimate motive to deleverage while there's still time. If you sell now and take the money to buy oil and gas, you can at least secure your energy supply. You'll need it for your economy after all. But if you keep waiting, a lot of bad things can happen, a lot of things can go wrong. Even if your reserves are intact, their purchasing power isn't guaranteed, not by a long shot. China's agenda is really simple, and we are seeing it play out today. There's a reality that, hey, we still need to hold some US dollars and US bonds for trade and imports, but at the same time, they are taking their dollars to buy lots of gold and lots of oil as we speak. In a story from Reuters, China added about 1.32 million barrels per day to either commercial or strategic crude stockpiles in August. Unlike the United States, China is boosting their reserves and inventories. The proceeds of their treasury bonds have to go somewhere, right? And they might as well go towards their oil reserves. It's a very simple choice. And going forward, we also see Beijing ramp up their de-dollarization efforts on trade. They'll run around the world, signing more bilateral trade agreements with BRICS Plus and other countries. They will move to trade directly in local currencies, bypassing the dollar completely. And if they accomplish that, we'll see them deleveraging even more US treasuries. And absorb this last fact, the Chinese yuan has already exceeded the dollar in China's cross-border trade for the first time. It has reached 49% of total transactions. More trade is being done with other countries using their own local currency. So just imagine what happens at 60% or even 70%. Will China then need a ton of US bonds? Let's watch this carefully because the wheels are turning fast. But let me know what you think in the comments below. Will China continue to dump even more? Can they de-dollarize the rest of the trade? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.